A hostile plot twist inside Paramount Skydance's bid to steal Warner Bros. From Netflix. Welcome back to Business Insights Daily. I'm your host, Sishan. Last week, we looked like the story was over. Warner Bros. Discovery had agreed to sell the studio and streaming business to Netflix for about $70 billion in cash, in stock, roughly $27.75 a share, after first spinning off its cable networks into a separate company. This morning, we got a fresh plot twist worthy of a streaming drama. Paramount Skydance, the media group controlled by David Ellison, says it's not backing down. Instead, it's launching a hostile bid for Warner Bros. Discovery, taking an all-cash offer of $30 per share directly to shareholders, arguing that this deal is not only richer but also easier to close. So, how is this big trade going to play out, and what are we going to do? The two bids: Netflix versus Paramount Skydance. First, the numbers. Netflix agreed upon deal was values Warner Bros. Discovery Studio and streaming assets are about $72 billion, or roughly $27.75 per share, paid with a mix of cash and Netflix stock. This structure requires Warner Bros. To spin off its cable networks to a separate company, then merge and sell what remains, primarily the studio, HBO, and streaming to Netflix. By contrast, Paramount Skydance offer is now offering an all cash bid of $30 per share, about $18 billion more to the Netflix offer, based on the implied equity value of WBD's outstanding shares. The structure that, according to David Ellison, does not require WBD to split into two separate companies before completion, which he argues will make it more quicker and certain to close. Paramount Skydance is essentially saying to its investors, Netflix may want the boardroom, but if you want more money and less complexity, come with us instead. Is this what it takes to make a hostile bid? Paramount Skydance is appealing directly to shareholders after WBD's board chose a different deal. So, why is Paramount going hostile? In the early days leading up to the Netflix announcement, Paramount Skydance was already accusing Warner Bros. Of running a biased sale process. In a public letter, it claimed WBD management showed clear favoritism towards Netflix, despite Paramount's higher offer. Public comments from WBD executives suggest that they reviewed Netflix as the natural partner, and changes to executive contracts and incentives may have titled decision towards the Netflix transaction. Then, by going hostile, the price gap between $27.75 and $30 is big enough to turn institutional investors' heads. Some shareholders would prefer an all-cash exit to the part cash, part stock arrangement with Netflix, whose share price could move a lot during the long regulatory review. And concerns about regulatory risk, especially combining Netflix's streaming dominance with Warner Studio Power, would make Paramount Skydance's deal look like a cleaner path. Antitrust and competition argument. Both deals face regulatory scrutiny, they're not equal. Netflix lawmakers of both parties have already raised antitrust concerns, warning that merging a top global streamer with a top Hollywood studio stifle competition in content licensing, harm rivals and consumers. The Directors Guild of America has expressed significant concerns about the concentration of power for theatrical windows and creative decision making, and regulators would like to examine whether Netflix Warner Bros. Would dominate not just streaming but upstream production in key franchises. With Paramount Skydance, the tie-up would still be huge, combining Paramount's film and TV assets with Warner Bros. HBO. But Netflix would remain a powerful independent buyer of content and distribution platform, which could help alleviate some single buyer fears. There's a lot more conventional logic. Two legacy studios combining for scale rather than platforms swallowing a studio. The how I built this angle, where strategy meets ego. From how I built this perspective, this moment is fascinating, but it's not only about spreadsheets. You got Netflix, one scrappy outsider that disrupted Hollywood from the outside in, now trying to build the very studio system it used to look down on. David Ellison, the son of Oracle founder Larry Ellison, trying to assemble a modern media empire by merging Skydance with Paramount, now reaching for a Warner Bros. Discovery as well. And Warner Bros. Company that's already been through multiple mergers and restructurings in the last decade, being asked again to bet its future on someone else's vision. But at this level, the story about control. Who controls IP? Who controls the distribution? And who controls the narrative about what Hollywood even is in a streaming first world? The hostile bid tells us that for Paramount Skydance, walking away was never really an option. But it also tells large shareholders, pension funds, asset managers, and long only funds now hold enormous power over the shape of the entertainment landscape. For now, we're in rare territory. A hostile takeover attempt not just for a company, but one of Hollywood's most storied studios, caught between the world artist streaming platform and rival studio group that refuses to back down. Thank you for listening to Business Insights Daily. Stay tuned for more in the world of business, information, and technology. I'm your host, Sashank. Thank you.